Recent research from Fathom Consulting conducted on behalf of Pension Insurance Corporation suggests that UK DB schemes could face a significant shortfall in index-linked gilts over the coming decade. Such a shortfall makes it more difficult, not to mention more costly, for these schemes to hedge their inflation risk. In today's roundtable, we'll be discussing some of the key findings of this report, as well as some of the challenges that UK DB schemes and their sponsors face on the road to buyout. So joining me in the studio today, we have David Collinson, Mark Gull, Danny Gabay and Andrew Brigden. Welcome to you all. So Andrew, if I can make a start with you, could you just give me a few of the key findings from the report?
Sure. I mean, what we found essentially is that defined benefit pension schemes that are currently facing a deficit of around 20% are facing something of a catch-22 situation. I mean, if we look at what official forecasts from the Office for Budget Responsibility imply for their position, we find that yields are going to normalise quite quickly, and that does wonders really for their funding position, because it reduces the liabilities dramatically. The OBR are also forecasting that growth will be pretty strong, averaging around 2.25% to 2.5%, and that the public finances will return to a position of surplus by, well, just before the end of the decade. And we find that if all this magical combination materialises, that the defined benefit, the deficits will essentially have gone away by the end of this decade, and that a vast number of schemes will soon reach a full buyout level of funding, which we take to be a situation where their assets are 125% of their liabilities. But it's a catch-22 situation, because if that happens, we find also that the demand for index-linked gilts is going to rise dramatically at a time when the market value of index-linked gilts is falling for two reasons. First, yields are going up, and that puts downward pressure on the market value of existing gilts. But second, the OBR, under their official forecasts, have the public finances returning to a surplus. So there's going to be less issuance. The value of the gilts already in circulation is going to be falling. And we find that there could be a shortfall that's worth in excess of £500 billion, which is actually slightly larger than the current value of that market.
The catch-22 in all of this is that that's one scenario. That's if the official forecasts are correct. If our own view is applied, which is somewhat less optimistic than the official forecast, then the good news is the shortfall in the index-linked gilt market is much smaller. The bad news is we still have a pensions deficit, and many more pension funds will go bust and end up with a pension protection fund. So either way, there's a problem that there isn't an obvious solution to, and that was the crux of our report, that something has to change, that the status quo will be a significant problem further down the line for the defined benefit pensions industry.
Okay, I mean obviously 500 billion, I mean that is a absolutely massive amount. Mark, if I can just bring you in here, is the government likely to have to increase its issuance to meet this demand?
Well, the industry's been aware of this for a while and has lobbied for an increased proportion of index-linked gilts to be issued, and at the moment the government issues somewhere around 25% of its gilts in index-linked. It would have to issue roughly 3 times as much, so 3/4 of the issuance in index-linked to get anywhere near this. That means the government would be taking a lot more inflation risk. Will they do it? I think it seems unlikely.
I mean, you mentioned there about the amount of extra inflation risk that the government would have to take on. Can you tell me a little bit more about some of the challenges the government would have to face if they did have to increase their issuance by such a massive amount?
Well, I think the challenge would be the smooth functioning of the gilt market as well, because there tends to be slightly less liquidity in index-linked gilts versus conventional gilts, because they're very much bought by people matching their inflation-linked liabilities, so they're not traded so much in the secondary market. So I think that potentially would be an issue. And again, there might be a change. If there was a change in the expected supply and demand in the conventional market, that could seriously move yields as well in that market.
Okay.
It's, another way of putting it is not so much the government taking on the risk, it's more a case of the government removing the risk from the private sector. Mm-hmm. The government would take away the need for the pensions industry to have to spend a lot of money protecting itself against what only the government can really affect, which is inflation.
Okay. David, if I can just bring you in at this point, what would be the impact of such a shortfall?
I think the impact is really on the long-term plans that most pension funds have today. if you look at a typical fund, it will be planning to have contributions paid in to reduce the deficit, and over a time horizon that may be 5, 10 or 15 years, reach a state where either it's self-sufficient and can manage all its own risks itself and just continue in that form, or it insures its liabilities. Now, in both circumstances, the end state that's targeted relies on there being sufficient protection available from the markets for inflation risk. And I think what this report shows is that there may well be a significant shortfall in that inflation protection. So that means two things for pension funds. Either they've got to plan to be in a state where really they won't be able to lock down all their risks. They will have to run continuously with additional inflation risk if they can't go out and buy it. So that changes the dynamic a bit of your long-term plan if you're really looking to say, we want to get to a position where the risks, essentially for the employer, are fully locked down. This suggests that could be problematic. The other aspect is that if there is only a limited supply of inflation protection, the cost of either reaching a self-sufficient state or insuring your liabilities will go up just from the natural balance between supply of inflation protection and demand for it. Therefore, whilst today 125% of target funding may be sufficient to buy out or reach self-sufficiency, that bar might need to go up. So pension plans' time horizons before they get to their sort of nirvana state will be lengthened out.
So maybe a bit of a cheeky question then, given what you've just said there, would you say that many of the long-term buyout or self-sufficiency plans of pension schemes are maybe resting on slightly shaky foundations at the moment?
Well, this report does show you've got to go back and question your assumptions that went into it. From the plans that I've seen of long-term plans of pension funds, they all pretty much assume if you want inflation protection, you can go out and buy it, and you can buy it based on market rates of inflation protection at the moment. So there is, I think, a need to look and say, do we actually believe in 10 years' time we'll be able to go out and buy this inflation protection just at the same time when all the other pension funds are seeking to do so as well? So, there's a sense saying, are we better off maybe phasing in the purchase of inflation protection and building it up over time?
I mean, Mark, if I just bring you in at this point, is there a substitute out there for index-linked gilts then if we're facing these problems?
I think that, there are other markets out there that can provide inflation. There's the swap market, but if banks are creating synthetic products that rely on inflation, they need to have that inflation themselves. So that's really very often a pass-through of other projects. There are things like the corporate index-linked bond market, but that is only a tenth the size of the government inflation-linked market. So it's a much, much smaller market and unlikely to accelerate in size in the way that can really fill the shortfall. The government's also talked about spending more money on infrastructure, and infrastructure projects could produce long-term index-linked cash flows, which would also help defined benefit pension schemes hedge their liabilities. However, that's been a fairly slow start, and again, the size of this that would be needed is substantial compared to the overall problem.
The bottom line is only the government and only the bond market, the secure government bond market, can really provide the protection the industry needs. Everything else is just too small or too slow or too risky. The industry is going to look for a way of hedging its position without taking on additional risks. And all these other instruments carry different risks.
And that's an important point that Danny makes. If you're hedging a liability and it's a long-term liability, 20 or 30 years, you need a very strong counterparty to provide that cash flow. So there's only a small number of infrastructure type projects or companies that can do that outside of the government.
And you have mentioned there about infrastructure, and it's been talked about a lot over the last 18 months or so. Does the behaviour of assets like that, does it match inflation in the same way as index-linked gilts?
It can do. It really does depend on the individual structure. And a lot of the thing about infrastructure is a word used to cover a very wide range of things. And if you have something that is producing a cash flow that has a natural index link to it, you can get those right sort of cash flows. You can't always do that. If you're producing a power plant, for instance, it may depend on power prices, and we've seen over the last few months how volatile they can be.
Okay. If I can just bring you in at this point, Danny, just onto an issue that we have kind of quite touched on about the potential cost implications here. You know, will inflation protection and buyouts become more expensive?
Well, yes, in a short. What we're projecting in our forecast is a combination of two unfortunate forces. There'll be a sharp increase in demand for inflation protection at the same time as the official government estimates suggest there'll be a significant decrease in supply. And so the inevitability will mean that the shortfall we're talking about of £500 billion will mean the price that people will have to pay to secure those assets will certainly go up from where it is today. Or pension insurance schemes and insurers are going to demand some kind of recompense in order to take on that additional risk. But that's what we mean by the status quo is highly unlikely to pertain into the future.
If I just bring in the guys from Pension Insurance Corporation at that point, I mean, given what Danny said, what does that mean for you guys as a big kind of, you know, de-risking provider?
Well, I think, firstly, I mean, part of the report was very good news in the sense that if you look at the government forecast for the economy and gilt rates and inflation, that implies that pension funds' position is going to recover dramatically over the next 5 to 10 years. There's going to be lots and lots of fully funded pension funds who and a proportion of those are going to look to buy out. So it sort of supports our thesis, but that there's potential for a significant increase in market volumes of insurance looking forward over the next 5 to 10 years. So that's the good news. In a sense, it justifies our business plans in saying, you know, we can write a lot of business in this market. The bad news, of course, is we don't want to go out and give unhedged inflation promises. So the bad news is there'll be a natural potential constraint on the amount of business we can write that relates to the amount of inflation hedging we can go out and get. So we need to think very seriously certainly over the next 5 years is if index-linked gilts aren't going to be there in sufficient quantities, how can we effectively ensure inflation risk at a price that the customers are going to be prepared to pay?
I think the point that's already been made is that, you know, the first law of economic supply and demand will be the key driver of where index-linked gilts are. They, as Danny has already said, it is likely they get more expensive even from the levels they're at now. But additionally, the other thing that we will do is try and encourage as much issuance of other index-linked paper outside of the government that can help alleviate this problem. So we'll be pushing for more infrastructure investments. We'll be pushing for more long-dated, secure cash flows to match liabilities.
But I think we're all agreed the first best solution is the government issues more government index-linked debt, because it's really the only issuer that can do it in the size required and can offer the guarantees required. All these other measures would be helpful, but it won't be enough on its own unless the government changes its policy.
I mean, there are other issues. There are other ways that, you know, if the government doesn't do that, you think, where does the risk for inflation remain? And I think that's one of the key things that we've looked at in the report.
Yes, that's why we called it who bears the risk, who carries the risk. So either, if the government won't accept it, then the scheme sponsors will have to, or scheme members. Because risk is like matter, it can't be destroyed, it can just be moved around.
That brings me on to my next question, which I think I'm going to put to David in the first instance. Will we see pension schemes increasingly look to offload the inflation risk onto their members, for instance, like maybe through pension increase exchange or transfer exercises, for instance?
Yeah, I think that's a real possibility. We've already seen, just in the last few weeks, an announcement. I think the TRW pension scheme bought out $2.5 billion of pensioner liabilities, where essentially my understanding is those liabilities have been switched from being based on an inflation-linked basis to a fixed basis, which effectively passes the risk of inflation being higher or lower than expected onto the scheme members. As the cost or scarcity of inflation linking and inflation protection grows, pension funds' ability to afford to pay quite significantly to members to take on inflation risk increases. So there might be a greater propensity to say, look, we'll give you a very generous offer on a pension increase exchange or a transfer value if you're willing to take the pension, the inflation risk. And that might those offers might be very interesting for the members, but it does fundamentally shift, if you like, inflation risk from being held by the government, and you could argue that they're the best people to hold inflation risk, onto next the sponsors. And then if the sponsors and schemes say, actually, we're not comfortable in the long run holding this risk, let's make an offer to the members so that they take the inflation risk for a price. And you could well see a lot of that happening.
Great. Just come to our final question of today's session. I'm going to start off with Andrew first of all, if we work our way across the panel. So Andrew, where can pension schemes go from here? Are we going to see a buy now while stocks last, or are there alternative routes?
I think if you believe the OBR's forecasts, and you would hopefully believe the analysis in our paper that stems from those forecasts, then perhaps now would be a good time to buy index-linked or inflation protection before it gets more expensive. I mean, I guess the alternative is that the OBR's forecasts are probably not really priced in by markets at the moment. The OBR has persistently been forecasting an improvement in the government finances that once a year gets put back roughly once a year. And if that continues, you may think that this, the rather rosy OBR scenario is not going to happen, and that this was Danny's catch-22 situation, that, that the deficits remain, and that you don't have all these schemes reaching buyout levels of funding. And I guess in that case, you may have bought too soon.
Danny?
Well, I'd reiterate what Andrew said, as you might expect. The simple point is that we have a mismatch, an inbuilt mismatch between demand for index-linked debt and the supply of index-linked debt, and only the government can resolve that. This isn't a political question. It goes across governments over decades. It's more of a treasury issue. That the simple way to resolve all of this is to issue a greater proportion of future debt as index-linked, and that would also show their underlying commitment to their inflation target, which is perhaps why they are reluctant to do it. Shifting the risk onto scheme sponsors is, I think, a very unpalatable solution. So individuals who don't have an alternative are going to be locked into a situation in which the actual pension income they receive is being determined by an inflation rate they can't control, and could find themselves deeply out of pocket. And that's something we would hope any government want to avoid.
I think it's really reiterating points that have already been made, that the analysis that has been done is, if the OBR forecasts come right, I think the amount of financial repression we have, in other words, pension schemes having to buy a limited supply of assets that only the government issues, means that probably interest rates and bond yields, index-linked yields, will stay lower than is forecast. And I think we'll in the end, we'll muddle through. It'll be very expensive for pension schemes to hedge. There will be people, including us, asking for more index link to come through. So far, the government has been reluctant to do that, but I think that cries for that will only increase.
And finally, I think in terms of how pension funds should plan, I mean, again, it's a question of not putting all your eggs in one basket. And if your plan is to be 100% inflation hedged over the next 10 years, don't plan to do it all in 10 years' time. Maybe think about how you can build things up over time. Take advantage of maybe slight blips in the index-linked market in the meantime to sort of start stocking up on inflation protection. But as I say, don't put all your eggs in one basket to say for buying all your protection at the end of your projection period.
Well, that's excellent advice. And index-linked debt is eye-wateringly expensive today, but it could be cheap compared to where it will be in 10 years' time.
I mean, final point. I mean, index-linked yields, real yields, are below inflation. So if you buy a government bond 50 years index-linked, you're locking into a return less than inflation of something like 60 basis points at the moment. They're that expensive.
Mm-hmm. Okay. We've come to the end of today's discussion. I hope that you've enjoyed it. I'd like to thank today's participants, Pension Insurance Corporation's Mark Gull and David Collinson, and Fathom Consulting's Danny Gabay and Andrew Brigden. And thank you all for watching.